You worked hard your entire life, saving and investing for retirement. You finally see a number in your RRSP or TFSA that feels like enough. Maybe it's 500,000, maybe it's $1 million, $2 million. You start to picture what life will look like when you no longer have to work. Travel, hobbies, family, freedom. But then something sneaky happens. Something most Canadians overlook. It's not a stock market crash. It's not taxes. It's not a bad investment decision. It's inflation. Unlike a market correction, inflation doesn't hit you all at once. It eats away at your savings slowly, year after year, like a silent thief. You barely notice it in the beginning. A few dollars more at the grocery store, a small increase in utility bills, maybe a slightly higher restaurant bill. But over 20 or 30 years of retirement, inflation can quietly cut your purchasing power in half. Think about that for a second. The same retirement income that feels comfortable at age 60 may not be anywhere close to enough by the time you're in your 80s. And unless you plan for it, you could be forced to shrink your lifestyle not by choice, but by necessity. In today's video, I'll walk you through exactly how inflation erodes retirement savings, why it's so dangerous for retirees in Canada, and most importantly, the strategies you can use to protect yourself. Hi, I'm Stefano Francesca, certified financial planner professional and senior wealth advisor at Next Step Wealth Management with IPC Securities Corporation. If you find this helpful, don't forget to like and subscribe. It really helps more Canadians see this. And if you want to see how well your own retirement plan is protected from inflation, you can book a time with me using the link in the description below. Let's break this down into 6 key parts. 1, why inflation is so dangerous in retirement. 2, the hidden ways inflation shows up in your daily life. 3, how inflation compounds over 20 to 30 years. 4, why safe investments aren't enough. Number 5, the role of CPP, OAS, and pensions in offsetting inflation. And number 6, strategies to inflation-proof your retirement plan. Part 1, why inflation is so dangerous in retirement. When you're working, inflation doesn't feel as threatening. Why? Because your salary usually increases over time. Even if you don't get a raise every year, promotions, bonuses, or job changes often help your income outpace inflation. But when you retire, your paycheck stops. Suddenly, your lifestyle depends on a fixed pool of assets, your RRSP, TFSA, pensions, and government benefits. If those don't keep pace with inflation, you fall behind. The danger is that retirees often think, I'll be fine, my costs won't rise that much. But history tells us otherwise. In Canada, long-term average inflation has hovered around 2 to 3%. That may not sound like much, but over a retirement that could last 30 years, it's devastating. At 3% inflation, prices double in about 24 years. That means $80,000 of expenses at age 60 could require $160,000 at age 84 just to maintain the same lifestyle. And if your income doesn't rise, then your lifestyle has to shrink. That's why inflation is often called the silent retirement killer. Part 2, the hidden ways inflation shows up in your daily life. When most people think of inflation, they think of groceries and gas. And yes, those rise over time. But in retirement, inflation shows up in other sneaky ways too. Healthcare costs. While provincial healthcare covers a lot, many expenses like dental, vision, medications, or long-term care fall on you. And those costs typically rise faster than general inflation. Property taxes and utilities. Municipal costs increase, and retirees on fixed incomes feel this pinch more than workers. Travel and leisure. Flights, hotels, and entertainment often rise faster than the general inflation rate. Insurance premiums, whether it's life, health, or home insurance, costs tend to climb as you age. The danger isn't just that prices rise, it's that they rise unevenly. Some categories hit retirees harder than working Canadians. And without proper planning, you might be forced to trim the very things that you looked forward to most in retirement, like travel, hobbies, or family support. Part 3, how inflation compounds over 20 to 30 years. Here's where inflation really stings, compounding. Think of inflation like interest, but in reverse. Instead of your money growing, your purchasing power shrinks year after year. Let's take a simple example. If your annual retirement income target is $80,000 today, in 10 years at 3% inflation, you'll need about $107,000. In 20 years, you'll need around $144,000. 30 years from now, you'll need roughly $194,000. Now think about that. If your income stays flat, 20 years from now, you'd be trying to live a $144,000 lifestyle on $80,000. That gap forces many retirees to either withdraw more from their savings, risking running out of money, or cut their lifestyle. This is why inflation isn't just a minor nuisance. It's one of the biggest risks to your retirement plan. Part 4, why safe investments aren't enough. When markets are volatile, it's natural to want safety. Many retirees lean heavily on GICs, bonds, or even cash. And while that can protect you from the short-term losses you might experience, it exposes you to long-term erosion. Here's the reality. If your investments earn a guaranteed 2% and inflation is 3%, your real return is -1%. That means even though your account balance looks stable, your purchasing power is shrinking every single year. Add in losses due to tax, and the picture gets worse. This is what I call the illusion of safety. Your money feels safe because it's not going down, but in reality, inflation is quietly eating it away. The solution isn't to avoid safe investments entirely. They play an important role. But your portfolio also needs growth assets to keep pace with inflation. Without them, you may preserve your savings on paper, but lose the lifestyle those savings were supposed to support. Part 5, the role of CPP, OAS, and pensions in offsetting inflation. The good news is not all retirement income sources are equally vulnerable to inflation. OAS, or Old Age Security, is fully indexed to inflation, meaning it rises with the Consumer Price Index. This makes OAS one of the most valuable inflation-fighting tools. CPP, the Canada Pension Plan. Like Old Age Security, CPP is indexed to inflation, ensuring your benefits keep pace. Defined benefit pensions. Some pensions include full or partial inflation indexing. If you have one, check whether it's fully protected, partially indexed, or not indexed at all. This means government programs provide a reliable inflation hedge. But here's the catch. For most Canadians, CPP and OAS combined may only cover a portion of retirement expenses, maybe $15,000 to $20,000 per person annually. That's helpful, but not enough on its own. The rest has to come from your personal savings. And if those savings aren't structured to grow, inflation will erode them. Part 6, strategies to inflation-proof your retirement plan. So what can you do? Let's walk through a few key strategies. Number 1, diversify across account types. A mix of RSPs, TFSAs, and non-registered accounts gives you flexibility to draw income in a tax-efficient way. Keeping taxable income lower helps your money last longer. Number 2, incorporate growth assets. Even in retirement, most Canadians need a portion of their portfolio in equities or equity-like investments. Not all growth is equal. High-quality, profitable businesses with a proven history of success may help provide both growth and income potential without taking unnecessary risks. 3, use an income layering strategy. Think of retirement income like building blocks, government benefits, pensions, and then withdrawals from savings. Layer them in a way that allows your income to rise with inflation. Number 4, plan for healthcare inflation. Since medical and long-term care costs often rise faster than the general CPI, build a buffer into your plan. That could mean setting aside a dedicated healthcare fund or considering insurance options that help cover those costs. Number 5, review and adjust regularly. Inflation isn't static. Some years it's higher, others lower. A retirement plan isn't set it and forget it. Reviewing annually ensures you're not quietly falling behind. The point is this: inflation may be silent, but it's predictable. You know it's coming. And with the right strategy, you can build a retirement plan that doesn't just survive inflation, it adapts to it. Inflation doesn't grab headlines the way market crashes do, but it's one of the most dangerous risks to your retirement. It works quietly, eating away at your savings, forcing you to either withdraw more or cut back your lifestyle. But it doesn't have to be that way. With the right investment mix, income and tax planning, as well as regular reviews, you can protect your retirement savings and maintain the lifestyle you worked so hard for. If you're a Canadian retiree or within 5 to 10 years of retirement and you want a personalized strategy to protect your savings from inflation, click the link in the description to learn more. Let's take the next step.